Short exercise 21-15, operating leverage. So what we're trying to do in this problem is we're trying to estimate the operating income if sales increase by 15%. So going back to our slides, we found out that there was a company with high fixed costs whose sales dropped from 12,500 to 10,000, which turned out to be a 20% drop. So then we calculated if they had a 20% drop in sales revenue, how would that affect operating income? So the way we did that is we took the 20% drop in sales, which is right here, and we multiplied it by the degree of operating leverage for that company. And that gives us a percentage change in operating income. In this case, a 50% change in operating income, which is pretty big. And that's exactly what happened. Operating income was 4,000, but when sales dropped from 12,500 down to 10,000, operating income fell from 4,000 to 2,000, which is a 50% drop. In other words, a 50% change in operating income. So using operating leverage can help you estimate how operating income will change in different scenarios. So in this problem, we're trying to figure out if sales increase by 15%, how will that affect operating income? And we'll use operating leverage to do this. So the first thing we need to do is to calculate the degree of operating leverage for a Fun Day Park. So here's a screenshot from our slides. Operating leverage is contribution margin divided by operating income. So contribution margin divided by operating income. Contribution margin divided by operating income. So we have to calculate our contribution margin and our operating income. Now operating income is more intuitive, so let's do that one first. So to calculate operating income, and this is a screenshot of our solution, you just take net sales revenue and you subtract both of the different types of costs, variable costs and fixed costs, and then that gives you your operating income. So to calculate net sales revenue, we need to find out the number of tickets they expect to sell. Now don't grab this 6,100, that's the break-even number of tickets. We want the number of tickets they expect to sell, which is 8,100. So that's where we get this 8,100. And then the tickets, the ticket price is $70 per person. So 8,100 tickets times $70 per ticket gives us net sales revenue of $567,000. And to calculate variable costs, we just take the number of tickets times the variable cost per ticket. So the variable costs per ticket are 42, and the expected sale of tickets is 8,100. So 8,100 tickets times 42 gives us 340,200. Then we just need to subtract the fixed costs, and the fixed costs are $178,000 per month. So then we take 567,000, subtract 340,200, and then subtract 170,800. We get operating income of $56,000. So now I can plug this operating income into the operating income box up here. 56,000. So next we need to calculate our contribution margin. So as a refresher, contribution margin is sales revenue minus variable costs. So we've already calculated that. Sales revenue minus variable costs. So I'm going to take 567,000 in net sales revenue, subtract 340,200 variable costs. So sales revenue is 567,000 minus 340,000 200 gives us $226,800 of contribution margin. An alternative way to calculate the contribution margin is to use a unit contribution margin. You take the sales revenue per unit, which is $70, minus the variable costs, which is $42. So 70 minus 42, which gives you $28 per ticket, times 8,100 tickets gives you the $226,800 of contribution margin. So you can calculate the contribution margin either way. So next, we're going to calculate the degree of operating leverage. So we're going to take 226,800 divided by 56,000. And notice it says round the degree of operating leverage to 2 decimal places. So 226,800 divided by 56,000 gives us 4.05. Degree of operating leverage of 4.05. So now we've calculated our degree of operating leverage. Going back to our slides, we calculated this degree of operating leverage. So if we multiply that by the percentage change in sales, that gives us our percentage change in operating income. So again, percentage change in sales times the degree of operating leverage gives us our percentage change in operating income. So our percentage change in sales, positive 15%, times our degree of operating leverage, 4.05, gives us the percentage change in operating income. So here's our calculation. Percentage change in sales, 15%, times the operating leverage gives us the percentage change in operating income. And then we have to multiply that by our operating income, which is $56,000, and that gives us our increase in operating income. So where did we get this operating income? We got it from up here. We multiply that by 15%, percentage change in sales, multiply it by our operating leverage of 4.05, and we get an increase in operating income of $34,020. So remember, what we're trying to figure out was what is the estimated operating income. Not just the change, but the estimated operating income. So to calculate that, we take this increase in operating income, which is right here, add that to our operating income, which again comes from here, and that gives us an estimated operating income of $90,020. So now I can plug this 90,000. Wonder if I can copy and paste. Cool. So increase in sales by 15%. We take 15% times the degree of operating leverage times our operating income, gave us our change in operating income, and then we add that back to the operating income, and that gives us our $90,020 of operating income, which is what will happen, which is our prediction what will happen if sales increases by 15%. So business consultants make a lot of money using calculation like this. So this is pretty powerful stuff. So to summarize, you can tell the CEO that if sales increase by 15%, operating income increases $34,020 for an estimated operating income of $90,020. And then you can collect your big consulting paycheck. So that's it for this problem.